My name is Ollen. I'm Vice President at Verdant, and I will be chairing the next session. Please allow me to introduce and welcome Audrey-Cynthia Yamadjako. I'm not sure if I'm pronouncing that correctly, but Audrey-Cynthia is the moderator for this session, and she's the coordinator of the African Green Bank Initiative at the African Development Bank. The title of the panel is discussing ESG and climate solutions to drive investment. So Audrey-Cynthia and the panelists, welcome to the stage. Thank you very much.
Hello?
Hello, can you hear me? Can you hear me? It's fine? Okay, thank you. Thank you. Good morning, everyone. I'm very pleased to be your host today on this panel. I'm Audrey-Cynthia Yamadjako. I will be the moderator of the panel about climate solution, how to drive investment in Africa. I will be here today with my honorable panelists. I have Enrique Tizon from IFC. I have Sanni from BII. I have Martin from the DFC, and I also have Eva from Yazhari, from Beyond Capital. Today's topic is really important for Africa. How do we drive green investment on the continent? This is a very critical thematic and topic. Why? Because we all know that Africa is the most impacted region in the world from climate change, and by hosting 9 of the 10 countries which are the most affected by climate change. The recent study showing the needs of 51 countries to achieve and to implement their NDCs by 2030 shows that we need 2.8 trillion USD to implement countries' national determined contribution. So it's a huge gap in terms of financing, but we can also see as an incredible opportunity, investment opportunity, to achieve a sustainable development in Africa. So how do we achieve this how do we translate this need into investment opportunity? We have to find projects on the ground which will implement this climate action, and we also need to find resources, climate finance, capital to invest and to match this demand. To do that, we need more and more financial solutions. We need to use what does exist, but we need as well to develop customized solutions to do this work. Today, we have the chance to be with incredible actor in these fields, which will be able to present and talk about what are the solutions they are bringing to the table. At the African Development Bank, which I'm representing today, we have seen this lack of climate finance as the biggest impediment to achieve a sustainable development. And we are implementing innovative solutions, such as the African Green Bank initiatives, to drive more climate finance to the continent. Why is it needed? Because we need, through these Green Bank initiatives, our goal is to create green investment vehicle in every region and country of the continent to bring climate finance at a local level. Because what we have seen so far is most of the climate finance are concentrated in the main climate vehicles, such as the Green Climate Fund, the Climate Investment Fund, the Global Environmental Facility, which are global, but also at MDB's levels, a little bit more on DFIs. But we need these concessional resources to de-risk green transaction and make those projects bankable to attract private sector. Because this action will not be possible without the private sector, the private capital. So the Green Bank initiatives is designed to achieve this goal, and we are happy we have launched this initiative at last COP, and we are happy to also start this pilot phase this year with the West African region. So I will stop here, and I will let our panelists to introduce themselves. Thank you. Please, Enrique.
Oh, thank you. Thank you, Audrey. So as Audrey mentioned, my name is Enrique Tizon. I actually lead IFC's syndicated debt business in Africa. And IFC, as you may know, is one of the largest investors in emerging markets. Let me share with you a few figures. For our fiscal year 23 that ended in June of this year, we provided around 43 billion of investment in emerging markets. How that translates to the African continent, we provided around 10.6 billion. If we strip out of those the short-term financing, more trade-related financing, we're left with 3.8 billion of own account investments in Africa. And that is coupled with 3.2 billion of mobilized funds from other investors, no? Generally like-minded investors like we have in the panel here. But like Audrey mentioned, we're going to touch a lot on climate finance. IFC is really committed to the SDGs and of course to climate finance as a top priority. We have committed that from July 1st this year, 85% of transactions flowing through the IFC system will be Paris Agreement aligned. And we expect that by 2025, same time in July of 2025, we will be 100% Paris Agreement aligned. In terms of climate, in the African continent, what we did in the last fiscal year is around 1.6 billion of own account investment, and probably with around 1 billion of third-party mobilized funds alongside IFC in those sectors. IFC, let me tell you a little bit about that own account, 1.6 billion. The majority of that was in the financial institution space, so we did this through financial intermediaries, the majority. But we did see quite a high uptick in the manufacturing space on our side. As you know, sectors like steel, glass, cement are heavy CO2 emitters, and we've had, I think this last fiscal year, around 5 cement transactions alone in the continent. No? One good example of this is the 124 million green loan that we provided to Sococim in Senegal. That came coupled with, we actively managed that syndication process with 122 million in local currency by local and regional banks. And this effectively, just to give you a sense of why we are invested also in that sector, really those funds are going to be used for the company's modernization program, which we have estimated will reduce around 312,000 tons of CO2 emissions per year. Basically, the company will produce cement at the lowest emissions intensities in the world, but in Africa. So that is definitely a little bit of an example of what we've been working on. And maybe finally, just to mention that IFC is also one of the largest issuers of climate finance instruments. We've issued 87 green bonds since 2010 in 20 currencies for about $11.6 billion. Let me stop there.
Thank you very much, Enrique. It's fantastic to see how institutions such as IFC has committed to be Paris aligned. This is going to be more and more mandatory. So most of the institutions will have to take this road. So this is really something every company need to think about, how they can be more Paris aligned in a certain horizon, because this is something which will be required by most of the biggest financial provider, investor. So I'm very, it's very important that you mentioned that, to see how the big commitment those institutions have now into the green fields. Thank you, Enrique. Please, Mike.
Absolutely. Thank you, Audrey-Cynthia. So I sit within our credit intermediation business at BII. So I'll briefly touch on 2 points. A, how BII think about driving climate investment in Africa, and B, specifically with a credit intermediation focus, how we're thinking about driving climate lending across the continent. On point A, as Enrique rightly says, as well as our commitments to being net zero by 2050, our interim targets by 2030, as an institution, we're also committing that 30% of our funds will go towards climate investments through to 2026. And that, at the moment, is the equivalent of around $600 million a year in Africa and Asia going towards climate investing. And when people think about climate investing, I think often people's minds go directly towards renewables, both large-scale wind, solar, and more kind of smaller scale distributed renewable energy, whether that be mini grids, commercial and industrial solar. And that, of course, is all critical. But I think it's important to say that as we think about climate finance, we really have to think about all of the sectors that are fundamental to the decarbonisation of markets, as well as helping them adapt to climate shocks in the future. So that includes things like e-mobility, green buildings and building materials, green steel, energy efficient manufacturing, climate smart agriculture, climate risk insurance, and many, many other sectors across the economy. And as we think about channeling more support into those sectors, we do so with debt, we do so with equity, and that's channeled both directly and through a whole range of partners. Which I think brings me on to point B, which is really, I guess from where I sit in the organisation, from a credit intermediation perspective, how we think about driving climate lending on the continent. And I think here we are, I think, very conscious that we have to take a very differentiated approach depending on the development of each type of company and where that sector is. And really, I think we take 3 broadly different approaches. The first is really around earlier stage, more nascent, often pre-banked climate finance sectors. And those are often where there is some combination of either business model, technology, or regulatory risk that often puts some of these companies at their stage of development beyond the appetite of traditional lenders. And there, I think we're seeing our role as really, how do we anchor dedicated climate lending vehicles, whether those be through fund structures or through specialized kind of non-bank financial institutions, to provide more flexible capital that's often higher risk bearing, and that really helps to prove business models, demonstrate track record, and ultimately create more assets for the kind of traditional lenders to be able to support. I think the second way is relatively more mature sectors, relatively more bankable sectors, our role there is really how do we help financial institutions to grow their climate portfolios quicker than they otherwise would have. So that's around using directed lending, it's around using credit enhancement products to remove some of the barriers around whether it be funding, whether it be risk appetite, whether it be capital constraints, all the things that are slowing down the kind of size and speed at which financial institutions are supporting climate-focused businesses. And I think it's important to do that not only with the kind of biggest banks that have the capabilities to attract those sorts of partnerships, but how do you think about doing that with smaller banks? How do you think about doing that with non-bank financial institutions? And happy to share some examples about how we're thinking about that. And then the third way, which I think is targeted at the more mature kind of climate finance sectors, but I think is one that we find more challenging, and I think one that we're trying to catch up with our partners at the IFC on, is really around capital markets and how you look at whether they be green bonds, green bond funds, securitized structures that really bring institutional capital, whether local or international, into the African climate market and allow them to access kind of assets that they otherwise struggle to. And that's one where we have a lot of ambition and have made some progress, but I think it's the one that we're the furthest behind on. And I think as we think about all three of those channels, I think the partners with whom we work with are quite different. So it may well be that we're working more with partners like Eva and Dia on some of the earlier stage businesses, and more trying to get into Enrique's syndications with the slightly more mature businesses. But hopefully that's a useful summary to start.
Thank you very much, Michael. It's really clear how working in Africa we need to find customized solution. We know that 80% of on the agriculture sector, more precisely, are based on SMEs and micro entrepreneur. When we talk about green, it's not only renewable or energy, it's also smart agriculture, resilience infrastructure, forestry, all those topics. It's a multi-sector topic, so we really need to look at as a whole, and to really find solution to bring the capital where it's needed in the form where is the most adapted, and this is I think what's there with what you are trying to do with DFC. I think it's a very good opportunity for us to hear from you.
Mm-hmm. Thank you. First, it's a pleasure to be here. My name is Dia Martin. I work in the social enterprise finance team at DFC, and I'll talk first about what we're doing at DFC at large, and then I'll hone in specifically to what the team I work on is doing as far as climate. So we have a real commitment to climate at DFC. We've hired a chief climate officer and a deputy chief climate officer to signal how important this is to our operations. Similar to BII, a third of our transactions have to be climate focused. So we're really looking at sourcing those types of transactions, both large and small. We've also committed to be net zero by 2040. And we're looking at or setting up a technical assistance facility focused just on climate. So that's DFC's commitment as an agency. Specifically within our team, the social enterprise finance team, I lead our Portfolio for Impact and Innovation program. This is a program where we work with early stage social enterprises and funds. We come in to support those funds, first of all, to support first-time fund managers' innovative fund concepts. So we have some funds that are looking at the carbon markets, also looking at kind of climate adaptation and mitigations and supporting SMEs in that space. But we also look at focus on social enterprises and companies, those that are scaling and growing that have a focus on climate resilience, adaptation, and mitigation. So we seek to come in and provide often that first institutional debt capital to support these companies in scaling and growing, and support these funds in reaching their first or second close. Currently, we have about 500 million invested under this program across 82 different companies and funds, and we seek to grow that. And what we've seen recently over the past 2 years is that those companies or funds that are focused on climate are growing within our portfolio. And lastly, I'll end with, we have a strong commitment to investment in Africa across DFC and also under this program. DFC's portfolio is about 40 billion, and I'd say a quarter of that is focused on sub-Saharan Africa, and we seek to continue to grow and invest on the continent. And it's also part of a USG government-wide effort called Prosper Africa, where we seek to harness all of the resources of the US government in a cohesive fashion to invest in Africa, supporting both companies, also supporting funds, and as well as the larger ecosystem. So happy to be here and answer any questions that you have.
Thank you very much. Yeah, it's really, when you see the level of commitment and investment bring to the table by your kind of institution, it's really something Africa does need. And you also talk about adaptation. Adaptation is what is the most needed for this is the continent of adaptation. We will say that most of our resources need to cover the adaptation sector. How do we help people to adapt to the adverse impact of climate change? And it's a good link with what Eva does in her company, because when we talk about adaptation, we have also to talk about health. We have also to talk about the other sector which are directly linked to climate. Thank you, Eva.
Thank you. Hi everyone. I'm Eva Yazhari. I'm managing partner of Beyond Capital Ventures. I think to follow on to you, Audrey-Cynthia, there is an S in ESG. And at Beyond Capital, I think we all know what that stands for. It stands for social. But at Beyond Capital, we do think a lot about climate adaptation as a part of our investment strategy. I'm very different than the billions to my right here. I am a VC that deploys $500,000 to $1 million at entry into companies, and then follows on in 2 of the top 4 emerging markets, and one of those being East Africa, where we originate half of our portfolio. So we see our portfolio as being highly intersectional with climate in multiple ways. We do have direct climate investments, some in common with some of the other panelists here, such as Ampersand. You may have heard Josh Wales speak yesterday. He runs an e-mobility business with a battery swapping network being developed across East Africa. But then we also have companies that are innovating around health and climate, or kind of distribution and climate in the portfolio, as well as companies operating in highly strategic climate countries, such as DRC, that are helping to boost economic development in a country like DRC, which holds a pretty significant carbon sink that is important, is strategically important globally. So climate weaves into our strategy and has done so much more over the past 5 years. But the roots of our fund are really providing access to need-to-haves, led by founders that we call conscious leaders. And when we think about this paradigm of a conscious leader, it's a leader who's thinking about all stakeholders. And the climate is 100% a relevant stakeholder in 2023, and certainly heading into the next couple decades as well. And so that's how we at Beyond Capital Ventures think and integrate climate. I do want to share a couple areas that I think maybe some of the companies need. Can I get into that?
Yes.
Is that okay, since I'm the last doing the introduction? I do want to share with all of you who are probably here to figure out how to put, how to integrate climate for growth into your portfolios, how to plug into some of the innovations that are happening. What we're really seeing is that climate founders need 3 things. They need partnerships to navigate, frankly, the gray of climate, like where do they plug in to various different capital needs, where do they, how do they describe their company, how do they context switch when they're raising capital, and also how do they measure the climate impact of their businesses. They also need financing for assets, and I know, I think Michael, you referred to this a little bit to draw a parallel, but they need financing for fleets of, e-mobility fleets. They need financing for asset leasing models to really develop some of the assets that are supporting their climate strategies. And they also need their financing models. Climate finance has come up a couple times already on this panel for consumers as well. So how do consumers afford an e-bike versus a petrol bike, and what are the benefits and education that's required? And then finally, we find that climate founders in our portfolio need incentive to do more. And one of the innovations of our fund is that we give a percentage of the profit share. So basically my GP carry, I give 10% of that to all the founders in our portfolio. And what we've done is we've linked a bonus around gender and climate to that incentive. And so we almost have a little carrot that we can dangle and say, you know, if this is an area that you focus on, we understand that as a founder, you're running a business, you're raising capital, you are the face of your company, you can't do it all in a 24-hour day. So we want to help you keep an eye on the ball of climate as a goal and something that you can work towards potentially in your business. So those are the three areas that we're observing at Beyond Capital Ventures. Thank you.
Thank you very much, Eva. I think you have covered the main 3 points, and it's really what you presented, I think, is not enough underlined, highlighted during session. Those are really practical needs and solutions we are trying, and needs we are trying to cover. Let me just briefly talk about what the African Development does. African Development Bank does. We are committed. We are committed to invest 25 billion as climate finance by 2025. We have doubled our ambition, our last ambition, where we have achieved 12.5 billion in investment for the last climate action plan, five years climate action plan. So we have doubled this ambition, and we are really also trying to create new vehicles to bring more climate finance at the continent. We have launched the climate action windows last year, which is supporting some more fragile countries by providing concessional resources. And with the African Green Bank initiatives, we are really working on what you said also, Eva, trying to, by your needs number 2, financing an asset, to work with commercial banks and governments, so we bring the kind of financing which are needed for those green project developers, so they don't have, they don't spend too much resources to look for capital because it's really demanding, and it's to apply to every envelope of fundings available in the world. You have to comply with each of those requirements. So that's why we really, especially in some region of Africa where the financial sector doesn't have already taken this green path, and see green investment still as very risky, to really change this paradigm, and those institutions need to be the first partners in line for those project developers, and also your funds are also very critical. So we have already a lot of institution and solution already on the ground. That's why we need those partnerships you're also stating on the first number. We need this partnership to bring, to know what is available and to make it more easier for those project developers to access those fundings. I wanted, Enrique, if you can touch a little bit more on about the syndication, because it's really an important role. Some of those fundings we are bringing are not enough, or doesn't have the concessionality needed, or we also, on green investment, most of the time we need this blended financing approach. Can we talk about a little bit more about what kind of solution, and how do you bring more investor at the table, bringing the different layer of capital which is needed to make those projects bankable?
Sure. No, thank you, Audrey-Cynthia. So there's, allow me to kind of give my response also with that investor mindset, because that is basically what we usually do in syndications, kind of put our put ourselves in the shoes of the investor that we're trying to crowd into, kind of see what works for them, what is it that they need in order to get to the finish line. You know? So there's several touch points, really, I would say. One is, first, capacity building, no? Because there needs to be several interventions, I would say, depending on the stage of where that company is. No? And I think Eva, all of the panelists really have also mentioned that. So capacity building is an important part. Working with those clients. Let me give you an example. We're working on a sustainability bond issuance together with BII for a mutual client. And before we got it, we engaged with the client. BII was already working on a sustainability framework with that client. So we're basically piggybacking off of that and kind of adding more value. So I think capacity building, we're training FIs in the region regarding their future prospects or projects in order to issue a green, blue, even and sustainability-linked bonds. That is, I think, critical. The other part that I also see a lot of investors quite interested in is to see some type of consistency across the different types of frameworks that are out there. No? So, for example, if there's already a widely used and reputable framework such as ICMA for green sustainability bonds, or LMA for the same, but in the loan space, why not try to align, be consistent with that? Because at the end of the day, the investors are looking at all of this and trying to match all of this together in order to be comfortable investing in that in that company. No? Sometimes investors are, or a client rather, is not ready to go to the market, right? With a bond issuance, with a green bond issuance, for example, or even with a green loan, and maybe have the available tools to kind of give those stepping stones for that investor, no? Kind of preparing themselves to actually access the climate finance market. No? One key thing that we have seen that has worked quite well is green building certifications, for example, the international reputed ones. IFC uses EDGE, which was developed in-house, and is widely used in Africa. And that has really given the clients that kind of discipline in ESG reporting, in that commitment, no, to sustainable and climate finance. And this is what the investors are looking at, no, that track record, really. No? A good example is Acorn, no, the real estate developer in Africa. Basically, when we engaged with Acorn, it was regarding a commitment that they had to make 100% of their real estate portfolio green, no, or green certified. No? So we worked, they got EDGE, and they actually fulfilled that commitment. And having 100% of their portfolio EDGE certified allowed them in 2019 or 2020 to issue the first green bond in Kenya. You know? So investors looking at that track record and seeing that this company was serious about sustainable and climate finance, they actually invested in them. The other thing that we have seen quite a bit that has worked in terms of actually crowding in investors into transactions is anchor investing in bond issuances. And it makes a lot of sense. If we have done, or any of us have done, the due diligence on that client, on that transaction, helped in structuring that bond, why not put our stamp of approval, no, on that bond, anchor the investment so that others will come into the bond issuance. And this last fiscal year, we Scatec, you know, the renewable energy developer, issued a green bond for 100 million. IFC anchored just about 20% of the bond, and you had insurance companies and of course international institutional investors investing in that or subscribing to that bond. One last thing from the investor point of view is probably, and I actually, AFDB has something similar to our MCPP program, which is a platform where we have basically agreed a preset eligibility criteria with investors. The latest one that we launched in September is called MCPP One Planet. And the main eligibility criteria is that the transaction is Paris Agreement aligned. So in that way, we're crowding in also institutional investors, insurance companies and other institutional investors into climate-friendly transactions. No? Let me maybe stop there for a
Fantastic. You gave very interesting topic. I'm wondering where I should start. I think what is really important is talking about, as you say, the framework. The project need to have the traceability and transparency to be compliant with the investor criteria and appetite. That's why working with, especially financial institution, it make the work more efficient in terms of capacity building, because they are the one who will be on the front line and will be able to work with project developer to explain and translate in practical world and practical action and explain how their project, how they should design their project to make it compliant and to the framework. So in Africa, we need to develop more of those framework, and we need as well to, by sector, but also in general, and we need to align them with the other framework which already does exist to help to mobilize resources from foreign investor on the other capital market which are existing. And I know that there is also a lot of appetite for those kind of products, even labeled in domestic currency. I think that, BII, you have a successful launch of your green basket. I think it was 1 or 2 years ago. I think it was 1 year ago. So you have all these experiences really working with those partners and providing customized financial products. Maybe you can talk more about that.
I think you're very generous about our experience in this space, but yes, I think it's 18 months in, so still work in progress. And maybe I'll keep the answer very brief, but I think this is really the partnership that we have with Symbiotics on this first green basket bond. And this product really came from, I guess, two genesis, really. One, I think we were hearing from particularly smaller financial institutions that, look, they did want to scale their green lending portfolios, but they wanted to do that with $3, $4, $5 million of capital, rather than taking a check from a DFI of $20 million and having 12 months with the clock ticking to disperse that into an area where they didn't have a huge amount of experience. And they also wanted kind of technical support and capacity building to build the right products, management information systems, the right processes, credit processes to build these portfolios really in a kind of robust way. That's on one hand. On the other hand, we were hearing from particularly institutional investors, look, there is too much climate capital chasing too few high quality scalable assets on the continent. And actually, how do we use innovation to create more assets that are at scale and that can be invested in? So really, this partnership is an approach to really trial a structure that says, okay, how do we support what the market needs? How do we support these $5, $6 million tickets to smaller financial institutions? How do we bring the technical capacity support to help them on that journey? And how do we aggregate all of those tickets into a product that's at scale and has track record? So it's also interesting for institutional investors. So we've trialed the first one. We took $75 million. We spread that across 11 different financial institutions across Africa and Asia. It's going well so far. We've commenced the kind of institutional investor engagement. So I think stay tuned. But I think it's that sort of mindset led by where the problem is, rather than led necessarily by the products that we've historically had, that I think are important if we're going to drive climate investment.
what you touch is really important. Is we used to see that the solution came from, let's say, the capital provider and not really from the needs. And more we are shifting to a more customized approach based on what is needed on the ground. And as you say, you are working more. You see that more. You need more small tickets. And it's important to make those kind of products available also to bring more private capital. When we see private capital, it's not only the problem or the issue of big company. Working, driving green investment is also our own. Everybody who has a savings can decide to invest in a great green savings, and those kind of resources, by the kind of securitization you are doing, you will be able to tap in those savings which are important for us, because I wanted to put my savings something which is sustainable instead of something which is not, because I'm looking for long term on the long term future. So I think it's really important to see how we can customize our fundings to the local needs, and yeah, this is what you do. You have this experience of working with SMEs and trying to match the demand. Maybe you can talk about that.
Sure. So first of all, I love sitting on this panel. I feel like I'm learning so much, and things that we can take back at the DFC and things that we could add to what we do. But I really think from working with smaller transactions, as a DFI, smaller is for us 2 million to 10 million. So I want to be clear, we're not reaching down to some of the SMEs that are sub 1 million or sub 2 million. But what we found when we first started our program is some key components really make a difference. First of all, when we looked at our process was designed for larger institutions, our credit review, so it's designed for larger project finance. So we had to tailor our entire process so that we could meet the needs, we could respond more quickly, and we were applying the appropriate lens to the companies we were analyzing. Also, a second thing we looked at was structure. At first, we were creating baby transactions at 5 million, similar to 50 million. And then we realized we need to be more flexible. Some of these institutions, is it really economical to collateralize all of these small pieces of collateral? Is it easier and more straightforward to look at different ways, to look at maybe just a guarantee or to be unsecured? So really looking at the structure of our transactions. And then third, we found that a lot of institutions, they receive a decent amount of capital early on, but there's this time period where it's very hard to raise additional capital to sustain their business, or they're spending an inordinate amount of time continuing to fundraise. So we thought this is a great opportunity for us. We don't necessarily look at being more concession on pricing, but we have the ability to provide a longer tenor. So we can go up to a max tenor within this program for 10 years to provide, and we typically are between 5 and 7 years, I'd say, but to provide long-term sustainable financing while a company scales and grows. And also looking at kind of the length of period to draw down on our financing. So sometimes we'll think long-term, this is a partnership, this is not just about one transaction. So we would look at this amount of financing is available, provided you meet this next milestone, we can provide additional financing. So they're not necessarily going through 2 fundraising cycles to meet the capital. They're looking more at their operational and financial performance. And I also think probably finally, I loved what you said, Ivo, on incentives. That's something that we've really looked at. We've piloted 2 gender-linked incentives for a couple of our early stage clients, and we're waiting to see how that performs, but also looking at ways to customize, whether it's revenue share incentives, looking at how we can use our debt or our technical assistance to really sculpt or customize our financing to support our clients is important to us.
Thank you very much. Yeah, as you see, you mentioned, it's really important to see the various type of support you are providing, from capacity buildings, from it's not only providing concessional loans, it's also about providing more long-term product, because I have a partner from the New Zealand's, the green banks. He mentioned that actually they are a green bank, but they don't provide too much concessional loan, because it's not that needed. When you take more time in preparing better the project, sometimes you reach the bankability which is needed, and you don't really even need the concessionality. So they really, so having those type of products available in all financial institutions is really it's really needed, the project developer, especially the green project developer, and having those to incentivize those project developers to because if they want to access these resources, they need to provide something sustainable, something which is compliant to the Paris Agreement. It's really important, because the country needs as well to build their NDCs, and this will be the baseline to also the kind of framework and the direction which is needed for the private sector as well to know what kind of investment or sector they need to invest in. So I think this, Eva, maybe you can touch upon that. I think that how your company you are supporting also, what kind of guideline they need as well from the country, and how the framework, they need to have some clarity about what kind of framework they should follow.
Yeah, I heard the double bell, but I'll actually just sum up by saying there's a very good report by the Aspen Network of Development Entrepreneurs called Andy Climate Guide, and it's a guide on frameworks. That being said, we find founders are too busy to put in place their own frameworks. And therefore, as an investor, we view it as our job to provide them with a robust framework that they can use to report to us. But oftentimes what they do is they just take that and make it their first cut of an ESG reporting framework internally. But that's a good maybe takeaway for everybody. And then I would just emphatically stress that in addition to asset financing or climate finance loan book financing, the need to really think through the structuring of that is important. As an entrepreneur myself, I have a very large stake in a mobility fund in the US, and we do fund mobility on the African continent. But I think we need even more experts around leasing models, around asset financing models. And it's going to be not just land, it will be land, sea, air. We happen to have a drone company in India already in our portfolio. That's also an electric vehicle company. But anyway, those are maybe a couple quick takeaways given the double ding that we've got. Thank you.
Thank you very much. I know it's 45 minutes. It's short to cover all the topics, and our panelists will be around, so we will have time to talk to them. Thank you very much.
Thank you.
Thank you. Thank you.
Yeah, thanks